Hi, my name is Anitra Preston.
And I'm Elridge Moore.
Welcome to Real Estate Talk from a private lender's perspective, where we talk about all things real estate with an emphasis on private lending. What's going on Wall Street? How does that affect?
What's going on Wall Street in the prime, Wall Street prime, it doesn't affect our money. But it do affect our sales cycle though. You know,
How's that?
and I will go into that. So as far as the bridge loan, we have bridge loans, a 6-month loan or a 12-month loan, right? And sometimes our borrowers will refinance us out. So it doesn't affect the bridge, which if we charge 13% interest, you know, it doesn't affect that loan, but it do affect the refinance. And the refinance, if they getting a 7%, 8% mortgage, 30-year mortgage, affect they profits and their cash flow per month. And that's what you wanted me to touch on?
I guess that was your answer.
Yeah,
you went into
yeah.
a real deep, but that was good. That was some good information.
All right, thank you.
Yeah, because I was more like on the upfront, side of things. Like if a borrower comes to us and you know we get that like, hey, how does the market affect your loan? It will, like you said in the beginning, it doesn't, right? We not change our interest rates because institutions change theirs. We don't change our interest rates because the Federal Reserve is tacking on an additional percent to a bank.
Right.
Again, all of our source of money is private.
Right.
So it's not tied to the banking system, so to speak, to where it's affected, to where we have to make an adjustment and say, okay, yeah, at one point we were charging 9 or 8%, and now we got to charge 10 or 12 to make up that spread of a difference, because of what the external markets are doing. That's not us.
Yeah, that's
right?
not our model. But a hard money lender, they may change. Like you mentioned the rock capitals, the iFund cities, and they will change with the Wall Street prime. And what we're seeing now is that all of the institutions is meeting us where we at.
Right.
In interest rates, right?
Right.
You know, and from the private lender and the hard money lenders, we are typically higher than bank financing, right? And right now we're seeing in 2023, we're seeing that bank financing is meeting us where we at.
Correct.
Yeah.
Correct. It's getting, they're going down though. The bank financing, you mean institutional financing is missing it. So he's talking about maybe like those non-traditional bankers or institutions like Rock Capital, Temple View, those kind of companies meeting us where we are on our interest rates. Our terms are still a little bit better though than them. I mean, you still on those guys, they still make you go through like some credit checks. And that's not to say that other private lenders don't do that, because there are some other private lenders in the country that do credit checks. It's just that with us right now, we haven't put that in place. We could go
into that. Like you mentioned the requirements. We could talk about the difference in our requirements versus institutional requirements. What's the difference?
Ooh, loaded question. The difference is a lot. One, we don't typically require any lengthy financial. We're not going to ask you for 2 years of bank statements. Now, that's not to say that another private lender.
2 years of tax return.
2 years of tax returns, I'm sorry. It's not to say that another private lender wouldn't require that. These are just our requirements. And if you are aspiring to be a private lender, look, you set that pace, right? As to what you are comfortable with. What's your risk tolerance? Everybody's risk tolerance is different, right? So we wanted to appeal to a specific audience. For me, when I first used hard money back in like 2005 and 2008, it was a pretty simple process, right? When these institutional guys come in and they start making it a little bit more complicated, you got to have a minimum credit score, you got to have 2 years tax returns, you got to show 3 to 4 months of bank statements. Well, those are all the requirements for traditional financing. For me, if I'm going to show you all of that, I may as well just go get a cheaper loan or position myself to be a better borrower to get the traditional loan because it's cheaper anyway, right? If I'm going to show you all that. At Vertical Capital, we require 1 bank statement. We don't even do 2 years of tax returns. We don't have a minimum credit score. We do advanced draws on construction and new construction. So those are just some of the caveats that we have in place in our building. Now, this doesn't mean that because we've lowered, I guess, for lack of a better term, the underwriting is a little lax as far as the finance. But our underwriting for the deal and who the borrower is pretty tight, right?
Yeah, definitely.
What you think about that?
But before I go into the underwriting, I want to touch on to the borrowers are not that experienced. What's the reason behind checking that 1 month bank statement?
So the reason behind the checking a 1 month bank statement is because we know as a newbie, as a person that's new to real estate or trying to get their feet wet, you're not going to necessarily have all that capital stack unless you've just been working in the workforce for a lot of years and saving and stuff like that. Is that what you were looking for?
Well, just to piggyback off that, in that 1 month bank statement, what we're looking for at Vertical Capital is if you could afford the loan, afford the down payment or afford the monthly payment. So we're looking for 3 to 6 months that's in that bank statement, and we're also looking for the down payment plus our fees and the closing costs that loan have. So if you don't meet that number, that dollar amount, most likely it's a denial.
Or we might ask you to bring on a capital partner too. So
yeah,
we try our best to mirror that of a bank where there is a denial. The only time we really deny a loan is if your numbers are just completely off. And at the end of the day, what you presented to us is just not a deal.
Right. Yeah, if you have a deal, we would recommend that you bring on a capital partner. You're right about that.
Yeah, so if you have a deal, we're going to try to, if you're short on cash, you're short on experience, we're going to make a few suggestions on how to get the loan closed because it's a deal.
Yeah.
But if it's not, we're not going to try to what they call it, a circle and a square peg.
Yeah.
It's room for disaster.
Right.
On a bad deal up front.
And fun fact though, I like that about us, because most lenders would just deny you.
Right.
We work with you to try to get the loan closed and actually make recommendations on how to get the loan closed. So good job, partner. Good job.
Good job.
But you asked me a question about the underwriting. What was that question again?
I can't remember what it was.
Well, we could just go over the details of our underwriting process. We consider ourselves asset-based lenders, right?
I would say so.
Yeah, so we look at the asset first. And from our experience, we evaluated thousands and thousands of properties here in the New Orleans metro area. And we have a real good process on our underwriting. So we're looking at how much equity the property have. Anitra, you have a construction background, right?
Yeah, I do.
And married to a licensed contractor.
Right. Construction specialist group. You looking for something?
Yeah, shout out Construction Specialist Group, Preston. So Anitra have a great construction background. I specialize more so on the numbers and calculating the ARV and things like that.
What's the ARV for those who don't know? What does that mean?
ARV is after repair value. My nephew over there, he knows what ARV means too.
You know what ARV means? Say it out loud, AJ.
Good job.
Good job, AJ.
But yeah, ARV is after repair value. So I'm more so on the number side of the underwriting process. Anitra is more so over the construction side of the underwriting process. When we bring those two together, we get a nice process to make safe and consistent loans.
I guess in another video, we'll have to dive in what that actually looks like. We'll take an actual deal or application, and we can actually show you guys how
that's a good idea.
We determine if this is a good deal or not. And maybe you can, and as you continue to follow us, you can participate, and we'll throw the numbers up and you let us know if it's a good deal or not, if we should loan on this or if we shouldn't loan on that. I think that might be something.
Yeah, that'd be great.
We can implement as we get into the next show, right? I think this kind of concludes everything for today. We went over what is a private lender. We went over some things about the difference between a broker and a direct private lender, such as Vertical Capital. You have anything else that you want to add to today's podcast?
Nothing I want to add. I just want to say, just like, subscribe, and comment.
And comment below on what you'd like to see.
Yeah, we're looking for engagement, and we're going to do our best to reply to any questions you guys have on this channel.
All right. Thank you. Till next week.